In 1720, one of the most intelligent human beings who ever lived lost a fortune. Not a little money, a fortune. The modern equivalent of several $1,000,000 gone in a matter of months. And this wasn't a con artist or a reckless gambler who should have known better. This was Isaac Newton, the man who invented calculus, who described gravity, who built the mathematical foundation for physics that we still use today. Newton had actually invested early in the South Sea Company, made a tidy profit, and sold. Smart move. He walked away ahead. But then he watched everyone around him getting richer as the stock kept climbing. And he bought back in, at the peak, and watched it collapse. He reportedly said afterward that he could calculate the motion of the heavenly bodies, but not the madness of people. Here's the thing though, it wasn't other people's madness that cost him. It was his own. And that's the part that should unsettle you. Because Isaac Newton wasn't running different mental software than you. He was running exactly the same software, the same brain architecture, the same cognitive shortcuts, the same psychological wiring that evolution gave every human who came before him and every human who came after. He was just unusually good at using it, and that, it turns out, made some of the problems worse. The disconnect. We have this assumption about intelligence and money. It goes roughly like this. Smart people make good decisions. Good decisions lead to financial success, so smart people should be financially successful. It makes sense. It's also not really what the data shows. A study by economist Jay Zagorski in 2007, using a data set following thousands of Americans over 2 decades, found something surprising. Higher IQ does correlate with higher income. People who score well on cognitive tests do tend to earn more. But when you look at wealth, what they actually accumulate, what they hold on to, the correlation falls apart. Intelligence and net worth, it turns out, are largely uncorrelated. You can be brilliant at making money and terrible at keeping it. And here's the part that actually gets strange. Some of the cognitive biases that quietly eat your finances don't just affect smart people. They affect smart people more. Bias number 1, the bias blind spot. There's a phenomenon in psychology called the bias blind spot. The basic idea is that we're all pretty good at spotting cognitive biases in other people, and remarkably bad at spotting them in ourselves. We see someone else making an irrational financial decision, and we think, that's obviously wrong. How did they not see that? Meanwhile, we're making our own equally irrational decisions, and we have a story in our head about why this one is different. That's the blind spot, and here's where it gets interesting. A 2012 study by researchers West, Meserve, and Stanovich found that the bias blind spot doesn't shrink with higher cognitive ability. It grows. People who scored higher on cognitive reflection tests, a proxy for the kind of analytical thinking associated with intelligence, actually showed larger bias blind spots. The smarter you are, the more confident you are in your own reasoning. And the more confident you are in your own reasoning, the less you question it. This is why knowing about biases doesn't fix them. Reading this is not going to make you immune. If anything, there's a version of you that finishes this video more confident that you see through these traps, when that confidence itself might be the problem. Bias number 2, motivated reasoning. This one pairs directly with the blind spot, and smart people are especially vulnerable to it. Motivated reasoning is what happens when you already know what conclusion you want to reach, and your brain goes looking for evidence to get you there. Everyone does it, but intelligence doesn't protect you from it. It actually makes you better at it. A smarter person can construct a more convincing argument for a bad decision. They can find the data points that support what they already wanted to do, build a story around it that sounds rigorous, and genuinely believe they've done real analysis. The conclusion comes first, the reasoning follows, and the smarter the person, the more sophisticated the post hoc justification. Bias number 3, overconfidence. Here's a number. In any given year, roughly 79% of actively managed large-cap U.S. funds fail to beat the S&P 500. Not most years, not bad years. Most years, including the most recent data available, the people running these funds are professionals. They have MBAs and quantitative models and access to research that you and I will never see. And the majority of them, most years, are beaten by an index that just holds the market and does nothing clever at all. And yet, surveys consistently show that the overwhelming majority of professional fund managers believe they will beat the market. This isn't stupidity, it's overconfidence. It's the same mechanism that makes most people rate themselves as above-average drivers. We are systematically, predictably bad at assessing our own performance relative to others. And financial markets are one of the places where that miscalibration is most expensive. The Mensa Investment Club is the most pointed example of this. Mensa is the high IQ society. Their investment club reportedly underperformed the stock market index over an extended period. Impressive intellect, collective analysis, and worse returns than just buying the index and leaving it alone. Bias number 4, loss aversion. In 1979, psychologists Daniel Kahneman and Amos Tversky established something that still holds up as one of the most replicated findings in behavioral economics. Losses hurt roughly twice as much as equivalent gains feel good. Losing $100 produces about double the psychological pain that gaining $100 produces pleasure. This asymmetry reshapes financial behavior in predictable ways. We hold on to losing investments too long because selling means making the loss feel real. We sell winning investments too early, locking in the gain before it can disappear. This is the exact opposite of what a rational investor would do. And it's not a mistake you can reason your way out of just by knowing it exists, because the asymmetry isn't in your logic. It's in your emotional response to numbers on a screen. Bias number 5, mental accounting. Behavioral economist Richard Thaler described what he called mental accounting, the way humans treat money differently depending on where it came from or which mental bucket it belongs to. Tax refund money feels like bonus money and gets spent differently than paycheck money, even though a dollar is a dollar regardless of its origin. Casino winnings feel like house money and get gambled more freely than money you earned. And, in the version that costs people the most, people will sit on low-interest savings while carrying high-interest credit card debt because the savings account feels like savings and the debt account feels separate, even though mathematically, paying off the debt is the higher return move by a significant margin. Your brain doesn't run a single unified accounting system. It runs multiple separate registers that don't talk to each other cleanly. And that gap between the registers is where money quietly disappears. The uncomfortable truth. All of these biases share something. They're not caused by ignorance. They're not fixed by education alone. And they don't scale down with intelligence. In some cases, they scale up. The problem isn't that you're not smart enough. The problem is that you're using a brain that evolved for a completely different environment, trying to navigate a financial world it was never designed for. The cognitive shortcuts that kept your ancestors alive on the savannah don't help much when you're staring at a portfolio of index funds and deciding whether to panic sell. The fix, when there is one, tends to come not from reasoning better, but from removing the reasoning. Automate your savings before you can decide not to save. Set investment contributions to a default and don't touch them. Run what decision-making researchers call a pre-mortem before any major financial move. Imagine it went wrong and work backward to figure out why. And when you notice yourself feeling unusually confident that this time is different, that's the moment to slow down, not speed up. You're not Isaac Newton, and neither am I. But we're running something very close to the same software he was. The same shortcuts, the same emotional responses to gains and losses, the same tendency to trust our own reasoning more than we probably should. The first step isn't changing your decisions, it's just noticing the system making them. Knowing the bias is there doesn't make you immune, but it makes you a little less surprised when it shows up, and a little more likely to pause before you act on it. Newton knew the heavens. He didn't know his own mind. You can do better than him.